Hi, I'm Carl Pearson, and this video describes the banking system and moratoriums, or moratoria, which took place during the Great Depression 80 to 90 years ago in the 1930s, and the wholly different banking system of today, and describes what legislation is probably going to be enacted in 2020 or 2021 to deal with a financial problem that increasingly unemployed and impoverished homeowners can't pay their home mortgages and are going to default, which could destroy the U.S. and worldwide banking system unless there is remedial legislation and as quickly as possible. I'm 83 years old, a high school dropout. I received my BA magna cum laude in political science. I'm a graduate of Harvard Law School, and I've been a small business owner for 74 years. Also, I ran or sought nomination on major third-party tickets for New York Attorney General, New York City Mayor, and even U.S. President. Also, I have defended foreclosure actions for the past 20 years, so I'm very familiar with foreclosures. Today is my 53rd day of self-imposed quarantine or stay-at-home lockdown. We have more than 1,300,000 confirmed cases and 75,000 deaths due to the coronavirus, and I'm most vulnerable and take quarantine very seriously. The Great Depression and the banking system. Prior to 1994, banks were not permitted to set up branches outside of the state in which they were doing business. Thus, for example, banks serving New York were not allowed to set up branches in any of the other 49 states. When the Great Depression was taking place, each state was on its own, similar to the present coronavirus situation, as to dealing with foreclosures, and 27 states enacted moratorium laws preventing foreclosures and/or evictions for a period of time. A federal statute was enacted to help farmers who had more votes at that time than city dwellers, and the act, known as the Frazier-Lemke Farm Bankruptcy Act of 1934, authorized federal courts to grant a 5-year moratorium on foreclosure and to scale down a farmer's debt to the current value of his or her property. 1 year later, in 1935, that act was declared unconstitutional under the Fifth Amendment as a taking of private property without just compensation, and that was done by the U.S. Supreme Court in Louisville Joint Stock Land Bank versus Radford 295 U.S. 555 in 1935. A subsequent statute in 1935 for a 3-year moratorium with the secured creditor's right to sell the property and redemption rights for the mortgagor was then enacted as an immediate response, and it was renewed 4 times, and that was called the Farm Mortgage Moratorium Act. And in 1937, the Supreme Court upheld that law in Wright versus Vinton branch of Mountain Trust Bank of Roanoke. The Great Depression, that is, moratorium on foreclosures. Faced with an unprecedented number of farm and residential foreclosures during the Great Depression, 27 states imposed temporary halts to foreclosures alongside other mortgage relief efforts. New York enacted a law that was all-inclusive, relating to all mortgages, and was therefore easier to implement. This is important to eliminate bureaucracy and delay and get relief more quickly, as we will discuss later. World War II pulled the U.S. out of the Great Depression and enabled many homeowners to pay their mortgages, and the Soldiers and Sailors Civil Relief Act of 1940 stopped foreclosures for millions of the nation's active military families. An important thing to remember is that there has been substantial criticism of the state moratoria laws and I give 3 links in my description for interested persons to go to as sources for the information I'm presenting here. The St. Louis Federal Reserve in 2009 studied why 27 states imposed moratoria while the other states avoided them. It concluded that while moratoria reduced the rate of foreclosures, they also reduced the availability of loans and made credit more expensive. The state laws enacted depended on which argument prevailed. The St. Louis Federal Reserve study concluded, and I'm quoting, over the longer run, foreclosure moratoria and other changes in mortgage laws may have made loans costlier or more difficult to obtain. Critics argued that foreclosure moratoria induce lenders to restrict the supply of loans and raise interest rates to compensate for the possibility that their right to foreclose on delinquent loans or to collect deficiency judgments will be constrained. On the other hand, in many states, the societal costs of widespread foreclosures were viewed as exceeding the costs of reduced loan supply and higher interest rates borne by prospective borrowers. Furthermore, foreclosure moratoria generally were viewed as expedients to buy time for the economy to recover and for the federal government to initiate programs to finance delinquent mortgages. That's the end of the quote. Conditions have changed in several respects, so that what happened in the Great Depression is not going to be a clear guide whatsoever. These are some of the major differences as I see them. 1. A politically deadlocked federal government as opposed to individual states. 2. A substantially worse economic crisis. 3. No World War II to pull out of the Depression. 4. Federal banking system instead of 50-state banking regulation. 5. Inability to work and a diversion of workers due to the coronavirus pandemic. 6. A split in public opinion which to a significant extent is against the economic interests. To put it another way, there seems to be many voters and residents who are willing to lose their homes if their political party wants it that way. Unlike the Great Depression, where most homeowners wanted to save their homes. So this is the background for my efforts now to figure out what should and can be done and how. First, the banking system today in 2020. Branch banking started with the enactment of the federal Riegle-Neal Interstate Banking and Branching Efficiency Act of 1994, signed into law by Democratic President Clinton. The law removed several obstacles to banks opening branches in other states and provided a uniform set of rules regarding banking in each state. States are not allowed to interfere with the federal banks, and the federal banks do not have to qualify to do business in any state. As an aside, the lack of any usury laws for credit cards in Delaware and South Dakota has attracted some banks to declare one of 2 such states as the primary place for doing business, so that the credit cards they issue in the 50 states cannot be challenged as usurious under the laws of any state. In spite of this, some states, most notably New York, have remained vigilant in maintaining fair lending rules. That was just an aside. The federal legislation needed today to save many millions of homeowners from foreclosure, here they are. There are 70 million outstanding house and apartment mortgages. That's based upon dividing the total mortgage debt, which I found for several years earlier, and by the average mortgage balance, it came to 70 million. Unless the mortgages are performing, that is, being paid on time or not later than 90 days after due, the mortgages are no longer kept as assets at the principal amount owed. And if enough mortgages become non-performing, the bank will face restrictions which will increase until the bank will finally be taken over by the FDIC or another bank. The job of our federally elected officials is to make sure that the expected financial depression doesn't take down the banking system, upon which all businesses and citizens and other residents and banks in other countries and other people depend. So here is what I believe has to take place in 2020 with bipartisan enactment, or in 2021 after experiencing a far more deteriorated economy by whoever is elected in November 2020. 1. A federal moratorium on 1 to 4 unit residential foreclosures and evictions as to homeowners who are living in their mortgaged homes for no more than 3 years or until the pandemic is resolved. 2. Mortgages as to investment properties, usually rented to a family for their temporary home, will be allowed to be foreclosed, probably with some relief such as 1 to 2 years for the renter to find another home or reach a rental agreement with the new property owner. 3. A reduction of interest rates and principal amount as to owner-occupied mortgaged homes to enable some of the mortgagors to continue paying their mortgages, but at a substantially reduced amount, which will make these mortgages performing and not be counted against the bank. The reduction in principal amount to present value is more difficult to make automatic and probably will be left for later enactment or for litigation. 4. To make the changes quickly, the changes will have some degree of automatic applicability instead of the usual lengthy process of the homeowner submitting a loan modification application with required documentation, receiving and responding to a missing documents letter, and then waiting once again for a decision, which often takes 3 months. 5. Payments directly to the banks to make up the necessary part of the monthly payment that are being forgiven, at least temporarily, by the relief being granted to homeowners who live in the mortgaged property. Those payments, of course, would be by the federal government. 6. Freddie Mac and Fannie Mae, as quasi-governmental agencies with almost 50% of the outstanding mortgages, will be easier to get in line, but will also need huge funding to avoid economic collapse. 7. Lurking around all this is the constitutionality of any losses suffered by the banks as to the difference in what they forego and what they are paid by the federal government, or perhaps the issue of whether a federal moratorium law is constitutional in light of the 1935 Louisville Joint Stock Land Bank versus Radford decision, which had a wholly different set of facts before it in 1935. And also you have to consider the favorable 1937 decision in Wright versus Vinton branch of Mountain Trust Bank of Roanoke. So, in summary, the mortgagee banks and mortgagor homeowners need relief, and an automatic moratorium for the mortgagor homeowners is needed, and the federal government will need to prevent the banks from failing by appropriate subsidies or bailout. Reducing the monthly payment will encourage more homeowners to make their mortgages performing once again, and a jobs program right away would substantially help in reducing foreclosures and improving the nation's economy. Well, I've said a lot, and it's what I plan to say, and I'll say so long until my next video.